So most people understand the concept of divergence. What I want to do tonight is talk about it in the context of more about how you can use it and identify it properly. So if you're at this point, let me pull my screen up so you can see this. So where do you go to find out if you actually are listening to this and you're thinking, I don't know what Ali is talking about here. Where would I learn about this? Divergence is in the analysis section of the training. So you just go to analysis, view the course, and if you scroll down, what you'll see there is a video under analysis tools that talks about divergence, and there is a live examples video there as well. So that will teach you the theory of what divergence is. What I'm going to talk about now is how to apply it. So we will touch on obviously how it works, but it's the key is how do you apply it? So what are you trying to do with divergence? Well, a lot of the time people get this element missed is you are all you're trying to do is predict whether or not you think there is going to be a change of direction in price. So an overall change in direction. So that would look like prices coming up, making higher highs, and then price changes direction and moves in a downward direction, or the opposite, price is making lower lows and it moves in an upward direction. So it's a change in the price action. And what we're ideally looking for is a higher probability that that change of direction is going to occur. So not only is there a greater chance that at that point price will not go higher or will not go lower, and that the extent of that move in the downward direction or in the upward direction is more likely to occur and continue. Does that make sense to everyone? But at the time that you're looking at the price action here and here, the technical element of the price action. So what I mean by that very simply is the higher highs and the higher highs here and the lower lows. There's nothing technically that's suggesting that that price is slowing down. Now, in terms of the core strategies that we trade, so if we think about our core reversal strategies or our change of direction strategy, we've got IR240s against the trend. We have got, for some of you, you'll be familiar with the MPR strategy. A lot of you won't be. Then you've got the SRPBs. You've got the 4-hour SRPB loss retest setups. So essentially anywhere where price is changing direction. Now, where you trade with these strategies is obviously dependent on the setup itself. So an SRPB, you're trading once, price has made a bit of a move already. So that makes divergence a little less important because price has already made the move. However, if you are trading up in this area here, so you're trading an IR240, which is a more intense change of direction, that divergence could be more beneficial because you're going to be getting in essentially before a trend line break and before price has shown you a lower low. So it's a more aggressive entry sooner in the sooner in what is the potential downward move where we're still more we haven't had any bearish technical cues that price may want to go lower. Okay. Now, when we look at divergence on an IR240, and for some of you watching, you might be going, well, I don't even know what the IR240 is. The key thing here is if you are looking to trade at an aggressive point in what is an upward or downward move. So if I'm looking here and I'm looking to trade, price has been going up, and I want to trade counter trend, as I've already said, if I'm going to trade a trend line break setup, I'm going to have to see price break the trend line, and I'm going to have to see price give me a low that is lower than the last higher low before I go any further on that trade. Give me a yes if you're following. If I'm looking at this, I have had two technical cues. The fact that the trend line has been broken, we've bounced off of either a level. So we will look for a level. That's one technical cue that we would want price to do, bounce off a level. We've had the second technical cue here. So that's one. Number two is that we have had price break the trend line. And then 3, the low that we have achieved, which is here, when price starts to move back up, anytime from this point onwards, we've got a low that is lower than the last higher low or opposite low before the trend was broken. So what we're looking at then is we've essentially got, I'm going to call it, we've got a lower low that is lower than the last higher low. So we have got 3 technical cues that give us potential bearish signals. That's no guarantee that price will go lower, but these are the technical cues that we look for on an SRPB. So the initial technical trigger is not price coming off the level. That's going to happen. The initial technical trigger for us to sort of wake up and go, now we've got a trend line break set up, is a break of the trend line. But if we take the same scenario, so we take the same scenario and we wind the clock back, get rid of these technical cues. If I'm going to be more aggressive and I'm going to say I'm looking to consider going against the trend, so rather than trend line break, I'm going to go against the trend, and we classify that as earlier, somewhere in and around this area, i.e. before price breaks the trend line and before we take this low out. In that scenario, I've got less technical cues. I've got the level, but that is it. Give me a yes if you're all following. Now, trade by trade, we don't know whether or not that level is going to hold up and price is going to move away in this direction. We don't know if it's not going to hold up. But what we've got is we've only got one technical cue. So price has proved itself less at this point that we are considering a trade than if previously we saw price do this, come down, break the trend line, give me a new low. Even though we're coming up in this scenario and we're looking maybe for a potential trade right there on an SRPB, we've got 3 technical cues in that scenario versus 1. So if I'm going to trade against the trend and I'm going to trade off the back of a level, I've got to be pretty good at assessing levels. So I've got to be what we would call right on direction. I've got to be right on direction a decent number of times. Give me a yes if you're all following. So one of the ways that I can potentially increase whether I'm right on direction is using the concept of divergence. So by using the concept of divergence, what that allows me to do is essentially add in another technical tool or another technical filter if I'm trading aggressively against the trend. So divergence allows me now to have another filter. So I'm racking up a few more filters. So when I add a filter, essentially I'm adding another requirement that I need to see price action do. If that requirement doesn't happen and I need that filter to be able to progress, then I have to leave that market alone. So by definition, if you were to go and look back at, let's say you went back and you found 20 examples. So you went back and you found 20 examples where price has got a legitimate resistance level based on how we assess resistance levels. So we're looking for a minimum of 2 hits. If you went and found 20 examples of price changing direction off the back of that, right? You may go and find 20 of them, and what you find is all 20 change direction. Give me a yes if that makes sense. And you're like, great. I've got examples where I've got legitimate key support and resistance level. I found 20 examples where it changes direction. But when I actually go and look at them and I look for the divergence, so I look for the highs to be going higher, but on the MACD, the highs to be going lower. I've drawn it badly. So I've got the divergence. I may only find the divergence on 8 out of those 20 examples. So that's an example of the filter at work. Yeah, you've gone and found 20 of these scenarios where price changes direction and moves, and you found 8 of them that actually have divergence. So on the face of it, you're like, well, that filter, if I was to use that in that example, there's no point using that filter because I miss out on 12 times where there isn't divergence and price change direction. But the problem is, and this is how a lot of people will approach their analysis in a random way. The problem with what I've said here is what? So the filter knocks out 12 of these scenarios. It reduces the number to 8 scenarios that change direction with divergence out of the 20. It's a small data sample. Absolutely, Simon. You've got it spot on. It's a small data sample. But what else? When you go searching for examples of where price changes direction and then looking for divergence, you're only searching for examples where price changes direction. So did the reversal continue? But how many times have you got a key level and price just blasted through it, or dipped down and then did that, or went a little bit higher and then did that and then did that? You've not included those in those 20 that you found. Exactly, Simon. Yeah. So your sample size is small, but you've also biased the sample size. So on the face of it, you're like, well, why would I bother using divergence? Because I miss out on 12 examples of where I don't need it. But if you were to go and say, right, I'm going to go and find key levels where prices come into that level and prices come in once, come in twice, and I'm not going to look for where price changes direction. What I'm going to do is I'm going to future pace it by scrolling the chart through or using the replay function. What I'm going to do is I'm going to go, right, is that a level where I would look for a change of direction? And you say yes or no. Make sense? So you call it ahead of time. And then what you do is you look to see, okay, is there a divergence? So what we call a point-to-point divergence, which I talk about in the training videos. So the highs of price go higher, but the highs of the MACD go lower. Or is there a trending divergence where I can say the last 3 points in the scenario do that? Are you guys with me there? So I've got a trending divergence or a point-to-point divergence, and then assess what goes on. So what you might end up is you might then go, right, I'm going to look at 50 examples. Okay, so I'm going to look at 50 examples, and I look at 50 examples, and only 20 of those examples have divergence. Give me a yes if you're following. But on the ones that have divergence, 16 of those have a clear change of direction, and 4 of them don't have a change of direction. Give me a yes if you're all following. So what I end up with is out of those 20, I've got a very high win rate in terms of change of direction. It might be that the number's higher. It might be 30, and I've got 24, 30 with divergence out of the 50. 24 do that, and 6 don't. Or 25 do it, and 5 don't. Who knows? Now, what you might find is if you actually were to say, of the 50, yeah, there were 25 that didn't change direction. There were 25 that did change direction. And only 5 of the 25 didn't have a divergence on them. So if we were to break those numbers down, let's actually break those numbers down and look at what that actually means. Where does it go? So if we take our non-divergence example, we've got 50 trades, 25 winners, let's say 2 to 1. Yeah. So you're coming out with 50R, 25 losers or trades that didn't change direction or only did marginally before they went the other way. So that's a minus 25. Yeah. So you're left with 25R in terms of win rate of 50%, but you've got 25R in the bank over those 50 trades. Let me know if that makes sense. If we look at our 20 trades that had divergence, 16 of them were winners. So let's use the 2 to 1 example, went in the right direction. 16 of those were winners, which gives us 32R. Make sense? And we had 4 losers out of those. So that's minus 4R. So what we end up with in that scenario is 28R. I'm making the numbers look quite preferable, but when you can trade less and make more or even the same, from a risk point of view, that is a better place to be because you are having to press the button less times to make a similar or slightly greater return. So there's two things that go on. Number one is just less risk. So each trade has a bigger bang for your buck. Are you guys with me? Each trade is worth more because although you are trading less, you are able to get similar or more. And you have to endure less losses. Does everybody understand what I mean by that? You simply only have to endure 4 losses, which is psychologically a lot easier than 25 losses. I would say in a scenario like this, if you were to rework the numbers and the numbers only came out at 20R here, if you rework the numbers so they equated to 20R, maybe even 18R. Now, on the face value, and this is where, again, traders go wrong all the time, they would look at this and go, well, I want to opt for this option here. I'm going to opt for this one because it makes me more money in terms of R value. Who's with me on that? But the challenge in that scenario is the amount that you have to trade. And this is the negative element, the amount of times you have to press the button to make the 25R. It's not wrong. And that's still a pretty good trade expectancy, but you've got to press the button 50 times to make 25R. Over here, you've got to press the button 20 times to make 20R. So each button push in this scenario is worth 1%, whereas over here, each button push is only worth 0.5% because of the number of losers and the higher trade frequency. So from my point of view, I would rather be actually almost worse off on paper, but if I can trade significantly less in terms of the number of trades that I place. Now, not everybody feels the same, but for me, I would rather do that. And then if I'm able to tally that change of direction to a bigger downward move, it could be that I could look to maintain a similar win-loss ratio. Maybe it drops a little bit, but I can work to a 3R target or a 4R target. Now, I'm not saying by using divergence, you're guaranteed to get the numbers that I've shown you here, but by using that filter, you're going to filter out a certain number of trades. And obviously, there's a fine line between filtering out too many trades. Obviously, if you reduce the trade frequency too much and you reduced it down to 8 and you had 7 winners and 1 loser, well, 7 winners gives you 14R, a 2-to-1. 1 loser means you're at 13R. That's probably reduced the trade frequency too much, even though that's still a hyper efficient R value. Now you're moving a lot further away from the 25R capacity here. Again, not wrong. And again, psychologically, that's much easier to deal with. And I'm not saying that divergence will give you that kind of win-loss ratio, but it's the idea to contemplate here is what you shouldn't be expecting with something like divergence, if you use it, is you shouldn't be expecting it to offer up the same trade frequency as if you weren't using it. All right, so that's the first lesson. Lesson number 2 that I wanted to talk about is if you think about our core swing trading strategies, any of the change of direction setups, so IR240s, which again, some of you watching this straight away, you may not have seen the videos, SRPBs as well. So these are change of directions. That's against trend, that's trend line break. Obviously, we've got 4-hour loss retests as well that we're running at the moment. Any of these, we have it set up within the core strategies that price needs to test a support or resistance, or for SRPBs, if it's a key level, it can get close. So we've got that factor of, okay, I need price to come in and basically test a resistance or test a support. Just give me a yes in the box if you're all following. That is part and parcel of strategy. So in that scenario, divergence is working and being used as a filter. So that has to happen first. Price needs to come into the resistance or support, and there needs to be a divergence. Okay, great. So divergence is being used as number 2 in the filter list. So it's being used secondary. There could be a scenario where you used it as an and or scenario. So The and scenario is price needs to come into a support and resistance, and there needs to be a divergence. Or you might say price needs to come into a support and resistance, or there is a divergence without a support and resistance. So then you give yourself the opportunity to look at a against the trend setup or change of direction setup, as in a trend line break setup. You go, okay, here's the support resistance. Prices come in previously. We've got a lovely level, either proceed with caution or in this example, a key level. Price comes up. We come down. We've got a lovely trend and price does that. And you're sitting there going, well, price is close to the level, but because now I've created an element of flexibility in my approach, I don't need price to be close. I need the market to be extended relative to where it's been. So I'm not looking up here to trade a change of direction. But this distance becomes less critical if there is a divergence, either a trending or a point to point on those two lows just there. So in a way, you're not using it as a filter to reduce the number of trades on a trend line break. You're saying, actually, I'm going to increase the number of trades that I take because I don't now need there to be a level if price is moving in the right direction, trending down, is extended relative to where it's been, but it never actually hits the level. Because at that point there, you've got a divergence that's replacing the need to hit the level, and you still need price to break the high, the last lower high in the move, and pull back, and vice versa, obviously, if it was a short. So when you're looking at a list, you might be going, well, actually, and if I use, I think it's actually moved on a little bit. Is it this one? So if we look at this example here, okay, there was one. I'll see if I can find it. Bear with me a second. So to give you an example, we've actually got an example of this occurring pretty much right now. Can you guys see that we've got two lows? They're coming in more as a double bottom just here. So not quite the lower low, but more as a double bottom. Yeah. And if we look, can you see that there is a step on the divergence there? So it's not the two most recent lows just here, but looking at the lowest low and then here. Now, again, it's pushing it a little bit because that's actually a higher low, right? So potentially a double top or a double bottom or a lower low. But what you're seeing here is the price is actually bumping up here. We've got our trend line. We've got a divergence here. It might be that price just doesn't want to make the support. It's turned a bit early, maybe due to what's happened in the markets today. Who knows? We've had a fairly strong upward day so far. So I'm looking at that saying that could be an example of where you would add that in and say, I'm okay to trade with that. And what I'm doing is I'm actually adding more SRPBs to my list, assuming, and again, you're not just taking this example and saying, okay, this makes logical sense. I'm going to add that in. I've got to make sure that if I'm adding that in, that I've tested it and it has an edge to it. I'm not just going to say, oh yeah, I'm going to add nearly level hits with divergence in. I want to know. But that's an example of where you're not using it as a filter to reduce the number of scenarios you trade. You could be actually using it to increase the number of scenarios you trade. So how could we use this as a way of trading with the trend? Okay, now there are examples of where people will show you this. I tend to be using this more as a change of direction scenario. Now, this is key. Change of direction can occur against the trend. It can occur later, which we talked about with a trend line break. These are all changes of direction. But one area that you can trade a change of direction and trade with the trend is through what we would call a fractal assessment. Now, what I mean by that, that's a fancy way of saying I'm just going to assess the market on a lower time frame. It's a fancy way. So it's just what we call fractal assessment. I'm just going to trade the market. I'm going to assess the market on a lower time frame. So to give you an example of this, if we were sitting in a with the trend scenario on the daily, and we were contemplating price pulling back on the daily chart, and we essentially want to continue to trade with the trend. So hypothetically, we want to trade and hope the price moves in that direction. Or we have a set of criteria that we are looking to deploy in and around various pullback scenarios. Now, remember, with pullbacks, some pullbacks are shallow, some pullbacks are steep, some pullbacks are slightly in the middle. So shallower pullbacks relative to the price action, maybe the 5 low moving average. Some pullbacks medium, the 21 moving average. Some pullbacks further, the 50 moving average. Give me a yes if that makes sense. Again, not necessarily saying we've got to trade all of them, but what we've got is we've got a scenario where price is pulling back to different points. So, Simon, I know you're exploring trading pullbacks and breakouts at different elements of this, and also loss retests in that direction, something we'll cover in a coaching insight session, not yours specifically, just conceptually what goes on. But another thing to think about when I was talking about is this change of direction here, change of direction here, change of direction, change of direction, change of direction. If I'm looking at a daily chart, if I was to go to a lower time frame, a 4-hour or a 60-minute time frame, then these downward moves that we're seeing here, here, and here, those downward moves will look more like this in the bigger scheme of things. Give me a yes if you're all following. So if I'm now going in and looking at it at a lower time frame, I'm zooming in. What I might be able to see is I might be able to see that although we're coming into the 21 moving average on the daily, that's also compiled with a divergence on the 4-hour or on the 1-hour. Is everybody with me? So then what I end up with is a trend line break setup, and the trend line break setup and the pullback on the hourly becomes my entry because I'm able to see that there is a higher probability of the divergence on the hourly plus the new high plus the pullback of that happening, and that being a legitimate, clear pullback on the daily happening there, less likely price rolls over the other way. So I'm actually not using it to trade with the trend. I'm using it the same way I would use it on the daily, a form of change of direction, but I'm adding it in on a lower time frame to trade with the trend in that move. Is that making sense? So if we take and we go down to what do I want here? I want the 60-minute chart. I'm looking to see, are there examples of a trending divergence? So here's an example here. Price has moved down. We've got a trending divergence between here and here. And we've got a point-to-point divergence between here and here. Give me a yes if you guys can see that. But at this point in the pullback, when price is coming down, we have got price showing no signs of divergence at that point. Next pullback here. What have we got? We've got a divergence. Again, the move isn't as big, but there is still a move that is outside of the trend line. Make sense? Still a move there. Are we seeing one here? Not really. Okay. There we go. Next pullback. Again, ignore my risk to rewards. That's something completely different. So there's just an example. It's just a visual example. So it might be that when you look at it, that more significant pullback, if it's coupled with a divergence, you can feel more confident about trading a bounce. Just look at the date. What are we looking at here? November, October 2025. Again, ignore the size of the move off silver. There you go. October 2025 price didn't make it all the way down to the 50, went past the 21 and then bounced at that point there. Yeah, fire away, Noreen.
Hi, Ali. So I've not heard the term point-to-point divergence. To me, it was just pure divergence.
Yes.
Can you just, yeah, can you just explain that again for me, please?
Yeah, let's use that last one because it's a good it's in a it's in a finite situation. So it's a one-time scenario.
Hmm.
Um, so when I say point to point, what I essentially mean is the last 2 points before the change of direction. So that would be here. So where this is used a lot is when we've got a support or resistance. So it's point to point is how you know divergence. So it's the last 2 points in the
Oh,
trending up or trending down move.
I
Yeah.
see. I get it. Yeah.
So it's not huge, but there is a
Yeah.
divergence there. Can everybody else
Yeah.
see that as well? Now, if we look back at when I talk about a trending divergence, if
Hmm.
we look at the price action here, this, if we look at this, we have got multiple lows in this process. Can you guys see that there?
Hmm. Yeah.
Now, if we look at these two, there's a divergence there. If we look at these three, there is not a divergence between here and here. Now, one form of trending divergence, which I think is probably the highest probability that, and again, I've got to be careful what I say here because I'm filtering with a little bit of bias. I haven't got exact numbers, but when I get three lower lows in a row,
Hmm.
so the price action does three lower lows, one, two, three, and I get three higher highs on the
Hmm.
um, on the MACD, very high probability. But that's
Hmm.
immediate lows, immediate clear bounces there, there, and there. But we don't have that here. Does that make sense to me? Is everyone else seeing that as well? We don't have that. So
Yeah.
it's not the most idealistic form of trending divergence. So the way to think about trending divergence is it's three or more lows or highs that correspond there. Okay, in an ideal world, and
Yeah.
vice versa the other way. Point to
Hmm.
point is the last two lows or highs in the move. And it's just it's not a
Hmm.
technical term if you were to look it up, it's the term we use to help you decide. But what we have got here, if you were to look at this low, and this is a slightly looser form, but this is also a form of trending divergence because those lows
Hmm.
are getting lower,
Hmm.
those lows are getting higher, all three. Yes, we've got all of this going on here that you're seeing there, but overall the price has gone lower overall, but the divergence is swinging higher. Is everyone else seeing what I mean by that?
Yeah.
Yeah. So this is not so this here is point to point. The pink is a form of trending divergence. The purest form of trending divergence is just simply the last three lows or highs in the move. Let's go and have a little look at, and I remember talking about this in the room, I think. Yeah, so if you look here, if we look at the S&P has obviously got no support and resistance, and you can see because I've already got fibs on there, risk to reward calculators. So if I look here and I look at the S&P has no support or resistance in the way. However, one, two, three highs. Let's look at where we are. There, there, there. We even go higher and go ever so slightly lower just there. Can you guys see that? So that's an example of where there is no support and resistance in the way, but there is a clear trending divergence there on the hourly. But it's the
Yes.
same thing applies here, right? So I'm going to take these two. I'm going to go, right, I'm going to color that in there. So that was the original one that I was looking at right there. Okay. You can
Yeah.
see the trending divergence.
Yes.
Let me configure this so we can see it on all time frames. And then if I roll forward to the one I was looking at more recently, it's another example where we're seeing a trending divergence. Let me draw it in. So from there through to there we got it. All right. So we've got two examples there.
Hmm.
I'm going to now look at what those two examples look like on the 4 hour. Any divergence on the 4 hour? None. See? Any divergence on the 4 hour? None. Does everyone just give me a yes in the box if you're all following? Noreen, does that make sense
Yes.
as well?
Yes, yes, it
Perfect.
does. I just,
So
and I'm
what
coughing,
I'm
that's all.
saying is it might be that sometimes you've got to go slightly lower in time frame to see the divergence. And obviously, we're not really going to see, we're seeing a flattening off of the MACD, but we're not really seeing a divergence because there's not enough price action. So you've got to bear that in mind. It's sometimes it might be the relevant time frame. There's the 30-minute on the first example. I scroll it back. There's the 30 minutes. So sometimes the slowing down is a little bit more intraday. There's another example
Yeah.
there of, it's in the middle of nowhere, lower lows. There's an example of point to point. This
Mm-hmm.
one, a little bit the same. There's obviously
Mm-hmm.
lows in between. Price can turn and change direction, and there's no example of it. It's not always going to be there.
Yep,
Sometimes price goes down and then continues to go higher. So again, it's something you can use a lot, but I think it's beneficial to look at in more than one way. And
definitely.
certainly, um, yeah, certainly it's been very useful for me over the years. All right, good. Okay. Any other questions?
Yeah, my second question was what you mentioned something about sometimes you will use the divergence as um a how can I say it? Instead of it's when obviously we look for price to hit a level, but sometimes you will use divergence instead of that. What data have you got with
Oh no,
that?
it's good question. I'm not saying I don't personally do
Mm,
that. So if we look at the New Zealand dollar, I think it was New Zealand dollar Swiss franc, wasn't it? Yes. If
hmm
we look at you can look New Zealand dollar Swiss franc. No, it was New Zealand dollar CAD, wasn't it? I think. Yeah. So if we were to use this, if this was to set up and do this, I wouldn't be trading it
hmm
because I don't know I have no data to suggest that.
Yeah.
My theory is that that would work quite well for a couple of reasons. One, no level, right?
hmm
Level is replaced with divergence. Okay.
hmm Yeah.
All right. So there's a direct replacement of the first element. Price still needs to make a trend line break,
Yes.
and it still needs to make, in this example, it still needs to make a higher high.
Yep.
So when you are replacing it with a trend line break setup,
hmm
you are replacing one of the three elements.
Oh, I see.
So let me spin it another way.
hmm
If you said to me, Ali, you had to replace levels
hmm
with divergence
hmm
on one of the strategies, I would replace it on an SRPB because if I put in the need for divergence, I've still got the trend line break and
Yeah.
I've still got the new high or the new low. So
Yeah.
if you said to me I had to do it without any testing and I had to do it on one of the two strategies, I would pick SRPBs to do it on rather than IR240s
hmm
because with an IR240, the only thing
Yeah.
you've got is the level before you get into the minute entry
That's right.
criteria. Now, I'm not saying that therefore it wouldn't work, but
Yeah.
I would if I was, because I've shown you an example there of the S&P, no level, but price change direction pretty nicely.
hmm It can happen. That's
It
it.
can happen.
hmm
So again, this is why. So for me, there at the moment, I have no data to say
Yeah,
that will
that's
work.
fine.
Now, the data I do have is on IR240s. I will only trade with a daily or 4 hour divergence. Now, what
Mm.
that does is on a strategy at the moment that's got quite a low hit rate, it really reduces the number of trades. But when
Mm.
we were busier on IR240s, that filter actually it did very much what I was showing you earlier, is it bumped the win rate up, but it reduced. So the win rate went up, the win percentage,
Yes.
but it lowered the trade frequency.
hmm
Now, at the moment, it lowers the because we're already lacking in IR240 trades because the currencies are very, very tight. Indices and commodities are trending without any support and resistance. And obviously, for an IR240, and against a trend setup, you need a support or you need a resistance. So the problem at the moment, we're lacking in IR240 trades because we're lacking in against the trend setups. Um,
Mhm.
it reduces it so much that it's not worth doing, if that makes sense.
Yep.
It reduces the trade frequency to almost nothing.
Yep.
So of the 10 trades in 18 months, it
Yep.
probably only gives you two
Get you.
trades. But if you go back to 2019 when we had the best part of 35, 40 IR240s, it could reduce it quite significantly, maybe down to 20 trades, but it bumped the win rate up by a lot.
Yeah.
Overall profitability was less, but
Yeah.
your bang for your buck, your trade expectancy was higher.
Yeah. I remember that.
Yeah.
Okay. Thank
Those were no worries. Those were the days. Yeah, when
you.
it will come. I was funny enough, I was talking about it in a coaching session, and it's something I'm going to talk about on Thursday, is the cyclical nature of what we're seeing at the moment. Why is it that we are seeing currencies very tight on across the board? We're not seeing
Yeah.
big trends. Why is that? I'm going to talk a little bit about
Yeah.
that. But also, what was interesting was one of the
That will be
things we're going to
interesting.
also examine is the data. So one of the things I was looking at over the Christmas break was the data of our swing trading results. And actually,
Mm.
a large percentage of our profit this year came from indices and commodities because we
Interesting.
haven't, yeah. So it makes sense
Yeah.
and this is why if you say, right, I'm only going to trade currencies, with currencies are trending less and indices are trending more, then you're missing out. Obviously, depending on what strategies you trade. But interestingly, a lot of people go, well, if I'm going to trade against the trend, that's not relevant to me. Whether markets are trending, I'm like, it is because you need markets trending to reach
Mm-hmm.
support and resistance levels.
Hmm.
Now, if currencies, and I can do this really simply and say, right, let's look at a weekly chart here, right? I'm on the S&P, trend, oh,
Yeah.
trend. I mean, interestingly, most of the pullbacks that we've seen, so this one was 50%, was 62% of that move. This pullback here was 50% of that move, and the previous one was even bigger. So you do get decent enough. COVID was a big pullback of the last trend. This was a
Mm.
50% pull. So you still get pullbacks on the on the indices, but the moves up, quite regimented pullbacks, much shorter. However, most of indices are in a lot of all-time high territory, so there's no support and resistance for us. So what we need for our 240s is we need more trending currencies to get to levels. But if we look where currencies have been very tight. We need price to get
Yeah.
up to here to get the reversal. Dollar Swiss, we need price to get down to the next level. And obviously, what we don't do is when price is tighter, yes, you might say, well, okay, I'm going to look for potential change of direction here, but you're not going to suddenly jump on a tighter range if your key levels are further away. So this is why we've had um, a lot less reversal trades. Still had some, just not as many. I say reversal against the trend setups. Yeah,
Makes sense.
no worries. Good questions,
Thanks.
Lorraine. Love it. Anyone else? Anyone got any observations or questions? Cool. That is all I'm going to cover on divergence. Hope that was useful, guys.